When the US financial markets descend into chaos, screens awash in red, indexes plunging, most people over 50 have the same reaction: panic. They log into their investment accounts daily with a heavy heart, watching their portfolio's value erode daily. Many rush to sell off stocks, moving their money into bonds or savings accounts to stay safe. They believe that at this age, there's no time left to recover. Losing a large sum now could mean losing their ability to bounce back entirely. However, in another corner of America, a small group of wealthy individuals behaves differently. Instead of fear, they smile. Instead of selling, they buy. While the majority seek refuge in low-volatility assets, they actively seek opportunities. And the remarkable truth is this: market crashes often occur when they accelerate their wealth accumulation the most. Why? Is it because they have nerves of steel, or are they reckless? Neither. They understand a principle that most traditional financial advisors will never tell you. After 50, if you know what you're doing, you can protect your wealth and grow it faster than ever. From my perspective, the key difference lies in how they define safety. For most, safety means preserving the nominal value of their money, avoiding all volatility. For the wealthy, safety means preserving purchasing power and income potential for the decades ahead. Achieving that requires a strategy almost opposite to conventional thinking. Take David, a five-year-old entrepreneur from Seattle, as an example. When the market plunged in early 2020 due to the COVID-19 pandemic, his portfolio lost more than 25% in just a few weeks. While friends his age panic sold to protect what remained, David doubled his monthly investments, scooping up shares of leading companies like Microsoft, Johnson & Johnson, and Procter & Gamble at deep discounts. Within 2 years, most of those investments had recovered and soared past pre-crash levels, delivering him hundreds of thousands of dollars in profit. Wealthy Americans over 50 don't try to dodge crises. They prepare and wait for them. When they arrive, they treat them as the market's rare clearance sales. That mindset is the fundamental difference and the secret to building, preserving, and passing on wealth for generations. The wealth preservation trap. Outdated advice. Walk into the office of most financial advisors in America and tell them you've just turned 50, and you'll likely hear a familiar line: "Now is the time to reduce risk. Shift into bonds, money market funds, or other safer investments. Focus on preserving capital at this age. You don't have time to recover from a major loss." It sounds reasonable. Millions of Americans have followed this advice almost religiously. They cut their stock allocations down to 40% or even 30%, putting the rest into bonds and other low-volatility assets. Some go even further, pulling out of the market entirely and parking their cash in savings accounts or certificates of deposit, CDs. This guidance is rooted in a reality from 40-50 years ago, when the average life expectancy in the US was just 70-75. And most retirees had guaranteed pensions from their employers or the government. Back then, you only needed to fund 10-15 years of retirement. Today, the picture is entirely different. Average life expectancy in the US now exceeds 80, and it's not uncommon for people to live into their 92nd or even 102nd. Many will need to fund 35-40 years after leaving the workforce. Meanwhile, inflation quietly but relentlessly erodes purchasing power. To put it in perspective, with inflation at just 3% per year lower than the historical average, your cost of living will double in 24 years. That means if you spend $5,000 a month at age 50, you'll need $10,000 by age 74. If your investments only generate 3-4% annually, as with many long-term bonds today, you're essentially standing still or worse, falling behind in real terms. I call this the safety trap, a form of psychological comfort that's slow-motion financial suicide. You avoid short-term risk, but you lock yourself into long-term danger, losing purchasing power and living a constrained lifestyle during what should be your most rewarding years. Consider Linda, a 4-year-old from California. In 2005, following her advisor's recommendation, she shifted over 70% of her portfolio into U.S. Treasuries and fixed income funds. The plan was to preserve capital and retire at 62 with peace of mind. But her portfolio barely grew over the next 15 years, while healthcare, housing, and everyday expenses surged. The result? She was forced to work an extra 6 years, despite declining health, to make ends meet. By contrast, those who maintained a significant allocation to growth assets, blue-chip stocks, index funds, rental real estate, not only weathered market volatility, but substantially increased their net worth. This leads to a truth that most personal finance textbooks fail to emphasize. After 50, your most significant risk isn't losing capital, it's losing purchasing power. I already hear the objection. But if the market crashes, I could lose hundreds of thousands of dollars. Yes, on paper, your portfolio value may drop. But if you don't sell and continue investing, history shows the US market has always recovered and reached new highs. The key is understanding the role of time. If you still have 30-40 years to live and invest, short-term losses matter far less than the silent erosion of your money's value over time. Wealthy Americans over 50 know this better than anyone. They understand that bonds and savings accounts are best reserved for emergency funds or short-term expenses. The portion of their assets that needs to grow must remain in vehicles capable of outpacing inflation. Once you understand the wealth preservation trap, you realize that safety doesn't come from avoiding risk, but from managing risk while maintaining growth. And that's precisely why, in the next section, we'll explore the wealthy's completely different mindset, how they redefine asset protection and turn crises into opportunities. The wealthy's new mindset: protect purchasing power, not just account balances. Ask 10 Americans over 50 about their financial goal, and most will answer, protect the money I have. It sounds logical after decades of hard work. Who wouldn't want to safeguard the fruits of their labor? However, the wealthy have a different answer. Protect what this money can do over the next 30 years. This isn't just a difference in wording, it's a life or death strategic distinction. The average person looks at the number in their account. The wealthy focus on future purchasing power and income potential. They understand that $500,000 today will buy far less in 20-30 years if it simply sits idle. Real wealth isn't the amount you can count, it's what that money can buy for you. Quality of life, financial freedom, and the ability to pass on value to the next generation. You're protecting an empty number if you protect the balance while inflation erodes purchasing power. Wealthy Americans over 50 put this principle into practice by focusing on long-term growth assets, stocks, real estate, and businesses. These three asset classes have consistently outpaced inflation over decades. They also follow a counterintuitive strategy, waiting for and capitalizing on crises. Instead of panicking when the market plunges, they view it as a golden hour to buy quality assets at bargain prices, turning short-term volatility into long-term advantage. The reason lies in a little-known concept, the reverse sequence of returns advantage. If you're in your 52nd or 62nd, still working and contributing regularly to retirement accounts like a 401k or IRA, market downturns work in your favor. You're buying more shares for the same contribution. When the market rebounds, your gains compound faster. Take Robert, a five-year-old software engineer from Texas. In the 2008 crash, his 401 lost nearly 35% of its value. While his colleagues shifted to bonds or stopped contributing out of fear, Robert increased his contributions from 10 to 18% of his income, loading up on S&P 500 index funds at historic lows. By 2023, his retirement account had tripled, far outpacing those who protected their balance by avoiding risk. This doesn't mean the wealthy ignore risk. They are deeply aware of it, but they distinguish between short-term risk, price volatility, which can recover, and long-term risk, loss of purchasing power, and income potential, which is often irreversible if you invest too conservatively. Another key point is that the wealthy think beyond their lifetimes. They don't just invest to sustain themselves, but to preserve and grow wealth for their heirs. This demands portfolios that beat inflation, sometimes across multiple generations. I saw this principle in action during the 19th of March ket drop in 2020. The market fell by over 30% in weeks, but wealthy investors didn't panic. My friend Mark, 52, from Denver, used his Crisis Opportunity Fund to buy Apple, Home Depot, and Johnson & Johnson shares. 18 months later, many of those positions had risen by over 60%. He told me something unforgettable. If you protect purchasing power, the balance will take care of itself. This mindset can be summed up in 3 rules. 1. Money must work constantly. Don't leave it sitting too long in low-yield vehicles. 2. Crisis is a friend, not an enemy. Prepare to buy, not to hide. 3. Protect your ability to create value, not just the value you already have. If you shift your focus from preserving the balance to preserving purchasing power and income potential, you'll start to think and act like the wealthy. At that point, every bout of market turbulence stops being a nightmare and becomes a doorway to some of your life's most significant financial leaps. The time and cash flow advantage. After 50, one of the most common misconceptions I hear from Americans over 50 is, "I'm out of time to invest." They believe age means the window of opportunity has closed, and the only mission is to keep their money safe. In reality, the truth is the exact opposite. If you're 50 or 55 today, statistics show you may still have 30, 40 years ahead for your money to grow. With average US life expectancy above 80, and many living well into their 92nd or even past 100, the post-50 stage isn't the end game. It's an entirely new chapter that can last decades. After 50, you may hold more advantages than younger investors. A 30-year-old has plenty of time, but less capital and lower income. A 50-year-old often has the reverse: substantial capital, peak earning power, and fewer financial burdens. Children are grown, the mortgage is nearly paid off. This combination of money plus experience plus decades ahead is a golden zone for building lasting wealth. U.S. Census Bureau data shows average income peaks between 50 and 60. Many at this stage earn the highest salaries of their careers, while fixed expenses are lower than during child-rearing or early homeownership years. That means more free cash flow, one of the most potent weapons when markets go on sale. Imagine this: the market drops 30%, and your portfolio loses $150,000 on paper. If you're 30 and only have $50,000 invested, that hit can freeze you in place. You don't have the spare capital to buy more. But you can buy aggressively at market lows if you're 50, earning $120,000 a year with manageable living costs. That's a power younger investors don't have. Take Michael, a 52-year-old property manager in Florida. When the COVID-19 crash sent U.S. stocks down over 30% in March 2020, many around him pulled out of the market. Michael did the opposite. With $80,000 in a dedicated opportunity fund and steady rental income from managing 12 apartments, he poured that cash into Costco, Apple, and JP Morgan Chase shares. Just 18 months later, that portfolio was up nearly 70%, far surpassing the initial drop. The advantage for those over 50 isn't just about capital and income, but perspective. They've lived through multiple economic storms: the 2000 dot-com bust, the 2008 financial crisis, and the 2020 pandemic. These experiences teach them that markets can plunge deeply and rebound to set new highs. As a result, they're less driven by fear and more prepared to act when others freeze. I recall a conversation with Karen, a 5-6-year-old from Ohio, who told me something unforgettable. "Young people see a market crash as a disaster. I see it as Black Friday. She leveraged the 2008 crisis to buy rental properties at nearly half the price. Today, her monthly rental income covers her living expenses comfortably without touching her investment principal. Wealthy individuals over 50 often use their advantage by 1. Maintaining active income as long as possible, funding their lifestyle and opportunistic investments. 2. Keeping an opportunity fund ready so they never miss underpriced assets. 3. Viewing crises as accelerators, not stop signs. If you're in your 52nd and think time isn't on your side, remember, you may hold one of the most significant investing advantages, the combination of capital, income, and experience. While younger investors must patiently grow wealth from smaller sums, you can make quantum leaps in just a few years if you seize the right moments. In short, at 50, time is not your enemy, it's your ally, as long as you use your cash flow and experience to make the market work for you. In the next section, we'll explore a specific strategy that turns this advantage into action: the Crisis Opportunity Fund, a tool wealthy Americans always have in place before a downturn hits. The Crash Opportunity Fund. Strategy. Wealthy Americans over 50 don't just endure crises, they prepare for them. One of their secret weapons for turning market collapses into wealth accelerators is something they call the Crash Opportunity Fund. This pool of cash or ultra-liquid assets is set aside exclusively for investing during deep market downturns. It's completely separate from an emergency fund and day-to-day living money. Its sole purpose, to buy quality assets when everyone else is selling. If you don't have this fund ready, a crisis leaves you with only two bad options. Either you have no cash to buy, or you're forced to sell your best assets at a discount to raise capital, missing the opportunity twice over. Here's how the wealthy typically build it, in 3 straightforward steps. 1. Protect your mind with sleep well money. First, they keep 2-3 years of living expenses in ultra-safe places, high-yield savings accounts, short-term bonds, or short-term CDs. This psychological cushion ensures that even if markets drop 30-40%, they can cover their lifestyle without liquidating investments. Example: Nancy, 58, from Arizona, keeps $150,000, 3 years of expenses, in a 4% high-yield savings account. When COVID-19 sent the U.S. by Lee, 19 sent the U.S. 19 sent the U.S. in due point. Stock market down over 30% in March 2020. She didn't panic. She reviewed her watch list and prepared to buy. 2. Stockpile ammunition for the sale. Once living expenses are secured, all extra cash flows into the Crash Opportunity Fund. This could be surplus income, bonuses, or profits from earlier investments temporarily pulled out of the market. Crucially, this money is not mixed with the leading portfolio. It must be instantly deployable. Example: Daniel, 55, from North Carolina, invested 15% of his net annual income into his fund. After 5 years, he had $200,000. When his local real estate market dropped in 2022, he used $120,000 to buy 2 rental properties at 25% below previous valuations. By 2024, both had appreciated and produced $2,500 a month in passive income. 3. Act decisively when the sale bell rings. When the market falls 20-40%, the wealthy don't ask, "How much am I losing?" They ask, "What can I buy below its true value?" Their buy list is prepared in advance: blue-chip stocks, index funds, prime location real estate, or even entire businesses. Example: Tom, 53, from Colorado, ran a printing company during the 2008 financial crisis. As smaller competitors folded, he used $80,000 from his fund to buy 2 rivals, acquiring their machinery and customer lists at a fraction of the value. 4 years later, his company's revenue had tripled, and the equipment alone had risen over 50%. Advanced tactic: controlled leverage. Some wealthy investors don't fear using low-interest debt to buy high-yield assets, such as borrowing at 6% to invest in a rental property yielding 9–10% annually. The spread, plus appreciation, creates compound gains. Case study. Rebecca, 57, from Texas, tapped her home equity line of credit, HELOC, in 2009 to buy 2 homes at 40% below peak prices. The rental income covered both principal and interest. By 2016, the properties had doubled in value, leaving her with near total ownership, mainly funded with other people's money. Why this works especially well. After 50, 1. You have peak earning power to refill the fund quickly. 2. You have market experience to identify real opportunities and avoid traps. 3. You still have decades for assets to recover and compound after a downturn. A crash opportunity fund is like a VIP pass to an economy-wide clearance sale. Those who prepare get to shop. Those who don't are stuck watching from the sidelines. In the next section, we'll look at a type of advantage no amount of money or portfolio value can buy, but one that determines who thrives in a crisis. The psychological strength of people over 50 and how they stay calm when the market drowns in fear. Psychological advantage and action plan. When markets crash, most people react emotionally, and the dominant emotion is fear. They see their portfolios bleeding red, panic sell to cut losses, and lock in permanent damage. But for many wealthy Americans over 50, this is when calm becomes their most valuable asset. The reason is simple. They've seen this movie before. They remember the 1987 crash, the 2000 dot-com bubble, the 2008 financial crisis, and the 2020 COVID-19 shock. In every case, the market eventually recovered, often to new all-time highs. This experience allows them to separate emotion from action, making decisions based on logic instead of fear. A strong mindset isn't innate, it's forged through experience. By age 50+, you've had enough time to turn market volatility into lessons learned, so the crowd no longer sweeps you up as you might have in your younger years. Take Paul, 53. A construction services business owner in Texas. When the 2008 crisis hit, many competitors downsized or closed branches. Paul did the opposite. He used his opportunity fund to acquire 2 struggling companies, buying their equipment, customer lists, and key staff for half their pre-crash valuations. Paul's company had tripled and expanded into multiple states 4 years later. This is the power of a calm mindset, paired with strategic action. When others retreat, you advance. When others see risk, you see opportunity. Your 4-step action plan. 1. Build your psychological safety net. 2. Keep 2–3 years of living expenses in ultra-safe channels, high-yield savings, short-term bonds, etc. This ensures you won't have to sell assets in a downturn. 3. Create a crash opportunity fund. 4. Accumulate cash or liquid assets solely for buying during significant market declines. Start small, but fund it consistently. 5. Prepare your buy list before the crisis. 6. Identify stocks, funds, real estate, or businesses you'd want if prices dropped 20–40%. Do the research now so you can act fast later. 7. Train for a long-term investing mindset. 8. Study the U.S. market's recovery history to reinforce your conviction. Always remember, crises are temporary, but growth is the long-term trend. If you're 50 or older, remember you're not too late to create a financial breakthrough. You're at a point where experience, income, and time converge to make this the best moment to turn crises into the most significant opportunities of your life. If this message has helped you see crises in a completely new light, drop a comment. I will prepare my opportunity fund to affirm your commitment. And don't forget to like, subscribe, and share so more people over 50 realize they can still build and expand wealth, no matter how turbulent the market becomes.